Now, we probably won't be seeing scenes like these this year. In fact, the 2020 holiday shopping season is going to look and feel different in so many ways. However, it's more important to businesses and the health of our economy than ever before. So what can we expect? Well, it's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
Joining me right now is Sound Income Strategies founder and CEO David Scranton.
They've created a new type of inflation. And although markets have always been an emotional place, they seem to be even more of an emotional place these days.
Jeffrey Small, market watcher, is with me.
Stock market dynamic is getting ready to significantly change.
So let's bring in our co-host, Jeff Small, president of Arbor Financial Services, and also the brand ambassador for the Retirement Income Store. With Thanksgiving just days away, the holiday season is officially here. And traditionally, the day after Thanksgiving marks the start of the busy Christmas shopping season, which many businesses depend upon for a huge chunk of their annual revenue. Holiday shopping and fourth quarter earnings will be watched even more closely this year as the country continues working to rebound from the initial economic shutdown of COVID-19. So what can we expect and what might it mean for the economy? What might it mean for the financial markets and possibly your investments heading into the new year? Well, we'll talk about that on today's show and discuss some of the key issues affecting the holiday shopping season, including some wild cards that could have major impacts. And joining me and my co-host Jeff Small will be economist, business professor, and author Peter Maurici, along with Eddie Ghabour, co-owner of Key Advisors Group in Delaware. But before we get to our first guest, let's take a look at where the economy and financial markets stand heading into this holiday season. Now, as I'm sure you know, the stock market surged to new record highs soon after the media declared a winner in the 2020 presidential race. While some of that rally was attributed to the election, market watchers agree it probably had more to do with the news that Pfizer and ultimately Moderna were close to giving us effective COVID-19 vaccines. Though the markets have leveled off a bit since then, all the major indices remain at or above pre-pandemic peaks. Now, whether this level of optimism is warranted is truly debatable, but there are some other positive factors driving it. Economic growth in the third quarter was a record 33.1%, which brought the economy back, as it's projected by the end of the year, to only within 3.5% below the pre-pandemic level. Spending on durable goods soared by 82%, and housing jumped by 60%. There's also been more good news. The number of Americans applying for unemployment aid has continued to fall, most recently to its lowest level since March. Now, yes, this is all welcome news, partly because it reflects a society that's adapting to this, as we call it, new normal created by COVID-19. Things like online shopping, virtual business meetings, and telecommuting have allowed the economy to continue digging out of this huge hole created by mass shutdowns when the virus first hit back in March. This adjustment to the new normal is one factor that bodes well for a strong holiday shopping season. Another is that many consumers who put off vacations and cut back on other expenses as a result of the pandemic may now have more disposable income. Of course, there's a dark cloud hanging over all this good news. And we all know what that is. Not only has the COVID-19 pandemic not yet been contained, but in many ways it's worse than ever before, with virus surges recently hitting new highs all across the country. And as a result, many states are reimposing stricter precautions and putting more strain on businesses and industries that rely on in-person customers. So all of this begs the question, is another major coronavirus setback in store for the economy? Well, we'll be talking about that coming up in just a bit. And now it's time to welcome my good friend and co-host, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida, and author of the Amazon best-selling book, Turning Financial Planning Right Side Up. Jeff is also our very own brand ambassador for the Retirement Income Store. We also want to bring in our first guest, economist Peter Maurici, professor emeritus at the Smith School of Business at the University of Maryland. He's also a former chief economist at the U.S. International Trade Commission. He's an author and a nationally syndicated columnist who frequently appears in the media. You can follow him on Twitter at pmorici1. Peter, thanks so much for being such a good friend of the income generation and being back here with us.
You're welcome.
So it looks like quarantining is treating you well. You have a new haircut, shorter hair than last time. And I've got to tell you, no bow tie. Wearing the traditional necktie. Is that a quarantining change? Is that boredom? I mean, what's going on there? I think it's the first time I've seen you without the bow tie.
Well, if you noticed, I also don't have glasses on. I had my cataracts fixed. And so this is my new softened image. You know, everybody thinks that economists are kind of like, some medical specialties that poke you in places you don't like. So I'm trying to be the soft and cuddly economist now.
Well, as long as your opinions aren't cuddly, that's all we care about. We want to get the straight story. So tell me, we 6 months ago, we were here, we were talking about what's going to happen economically in second quarter, third quarter. And you were pretty optimistic. You were talking about a modified V recovery. But tell us, are you even surprised to some degree the extent to which the economy has recovered thus far?
Well, no, the bounce that we got in the third quarter, given the amount of money that was pumped in and the amount of, in terms of the CARES Act and the amount of money that the Fed printed, which was huge, is not surprising. What's disturbing to me is there hasn't been follow through. That now that we see that the pandemic is lasting longer than we expected when we passed those laws, we're not getting a follow-up stimulus. So we really are in that K-shaped recovery. And we really need a new, large, substantial, and significant, well-aimed stimulus package to turn that K into a V. So, because an awful lot of people are getting left behind. By my estimate, we're going to have about 5 million people who are structurally unemployed come February, people whose jobs have disappeared and there's no hope of them ever coming back.
So if we get that package, let's say February 1st, which is looking more and more like we might, is that too little too late?
No, I think it's never too late, but I think that Mr. Biden is going to face a tougher economy than he should have to face if Nancy Pelosi and the president would put on their big boy and big girl pants, so to speak, and get the deal done. One of the problems is that with the Georgia elections still out there, the runoffs, is they continue to posture as if they're in campaign mode. With Pelosi, sticking to her guns that she wants $600 a week, when that's more than people earned, in supplemental benefits. And McConnell on his side saying, we got to be fiscally conservative and nothing over $1 trillion. Well, heck, we need a half $1 trillion just for the states to cover their revenue shortfalls. And then we need a lot of other stuff too.
Yeah, you're right. Absolutely. Jeff?
Yeah, Dr. Morici, the economy has recovered much quicker than anybody anticipated. The unemployment rate's lower, consumer demand is higher than we expected, retail sales look robust for the fall. All the economists got it wrong, except you. When we talked to
I
Nate,
wouldn't go that far. Okay, I think there were a few others out there. Okay, but certainly we were a minority.
There were, but the majority of economists get it incorrect. Why is that? Why did they miss so much? You were much more accurate than most of the folks that we talk to in the world of economics. So why did most of them get it wrong?
Well, you got to remember, most of the people that you talk to are either macro forecasters, people that do it for a living, or like they work at the Fed, or people that basically take their forecasts, read them, and come in here and then talk about what they've read. And, macro forecasters reduce the economy to a few equations, never really enough to reflect the reality around us. And they don't pick up changes in the structural environment. It's very similar to the problem right now that hedge funds are having and momentum funds are having. Their formulas and criteria based on a world that doesn't exist anymore.
Hey, 45 seconds, Peter. So how about the stock market? Are you surprised to the extent to which the stock market has recovered, creating several new record highs?
Oh, no. If you go back and read my emails, you'll see that I said we were going to just pop along. Okay? I said we were going to have a summer rally.
But even new record highs like this?
Well, I can't say that I called that, but we're not substantially above the old records. So it was certainly within the realm of plausibility. I've always maintained that the stock market come the second quarter of next year, by that time, we're going to have the vaccine building out in a dramatic way. We're going to have a stimulus.
That's right. And Peter, we need to take a quick commercial break. Right after the break, we'll come back. We'll ask you about next year. I'm dying to hear what you have to say. You stay with us. We have more coming up in a moment right here on The Income Generation. We'll be right back. I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Don't waste any more time. Visit myfreeretirementreview.com to find out if you have the right retirement strategy in place.
So what exactly are some of the trends and changes being forecast for this holiday shopping season? Well, one potentially positive change is that the season will be longer. As we mentioned at the top of the show, Black Friday is traditionally when most people start their holiday spending. However, like most things, that's different this year. Amazon basically pegged a new date for the start of the season with its Prime Day sales event back on October 13th. Other big retailers, including Walmart, Target, Best Buy, and Kohl's, responded with similar promotions, jump-starting their holiday shopping seasons 6 weeks early in order to remain competitive. Fortunately, shoppers have responded. According to one survey, 49% said they had started their holiday shopping before Halloween. Now, whether the longer season means customers will spend more still remains to be seen. But one thing is already certain. More people than ever will be shopping from home. As we've noted on other shows, the trend toward e-commerce and away from brick and mortar stores was already underway before COVID-19, but the pandemic turbocharged it. With coronavirus cases spiking again, it's a safe bet many Americans will be cutting back on traditional in-store shopping or perhaps skipping it altogether in favor of online shopping and home delivery. Several recent surveys confirm this trend, as does the recent move by UPS to step up hiring for an expected surge in package volume in the coming weeks. Other big retailers hiring for the holidays are also mainly employing warehouse and shipping workers, not cashiers and shelf stockers as usual. The good news here is that in the last 8 months, many businesses, large and small, have greatly expanded or improved their online offerings and online abilities. They've adapted to this thing called the new normal. The bad news is that many businesses that depend on the traditional holiday shopping scene, restaurants, bars, theaters, and so forth, will likely suffer this holiday season. And the same goes for hotels and the entire travel industry, as people opt to stay put rather than take a holiday trip or even visit family. In fact, the pandemic will sharply reverse a consumer trend observed in recent years, that of gifting experiences rather than merchandise. Things like hotel reservations, concert tickets, and restaurant gift cards. This year, thanks to the pandemic, it will be back to basics for gift giving, whether that means a new bowling ball, socks, or a Red Ryder BB gun. How will all of this balance out in terms of its impact on the economy? And what are some of the wild card factors that could affect the answer? We'll talk more about that coming up in just a bit. Now it's time to bring back in co-host Jeff Small, as well as our good friend, economist and author, Peter Morici, which you can follow on Twitter at PMorici1. So Peter, I had to cut you off for that commercial break there just a moment ago. Okay, so you weren't that surprised about the market hitting record highs, because I know we talked back in May, and you even talked about PE ratios back in the mid, maybe even high 20s as being okay in this low interest rate environment. So what do you see in the stock market for next year, for 2021? Okay.
Well, consider this. The average S&P over the last 25 years has been 26, and it has been drifting upward. Now, interest rates being so low indicate it could go up to 30, 35. Right now, we're at the upper end of that band at the current S&P. We're up around 35, 36. However, between now and the second quarter of next year, FactSet has got year over year earnings bouncing up by 40 some percent. If you do that, then the PE ratio at today's prices falls to like 22, 23. So with a target PE of 30, you've got a lot of room to grow. My feeling is the real problem is trying to discern where that growth is going to be. I mean, who'd have thought, 2 years ago that we'd have a year like this where the energy companies are down 40% and the technologies are up 40%, 80% differential. The real key, if you're a stock picker, and I'm an advocate of just index investing, but if you want to have some fun gambling, I mean, what are the tour companies that are going to be best positioned to get old people to get on boats again? What are the hotel chains that are going to win the most confidence as people start getting back on airplanes? Those are interesting questions to ask. And also, I got a kick out of it as soon as we got the first vaccine report, Zoom stock fell like 20% that day. Is that really true? Or if people learn to Zoom more? It's the proportionality of the structural changes that we have now endured. How much will that continue? And then relating that to stocks, that's the key to succeeding going forward.
Yeah, it's funny. Our equity portfolio manager has said in his 30 plus years, he's never seen this level of whiplash between different parts of the stock market. Isn't that right, Jeff?
Yeah, the whiplash has been crazy. I mean, I have to get a massage almost weekly now because of it in the markets as we get whipsawed back and forth and back and forth. But, we're having this competition now amongst Moderna and Pfizer. First, Pfizer says 90% effective, then Moderna says 94, and now Pfizer says, hey, we're 95% effective. So we can see who wants to be the king of the hill with the vaccines.
96.
Soon, 96 is coming. But it's great that we've got the vaccine on deck. The problem is, we got to be able to roll it out quickly. And if it's going to roll out the second half of next year, and it's going to take through the third or fourth quarter to get it out to the American public, Dr. Maurici, do you see more volatility potentially in that delay?
Well, if we have that kind of delay, we're going to continue to have volatility. But I don't see necessarily having that kind of delay. Pfizer's talking about applying within days for authorization to go forward. Now, they're a 2-shot vaccine, which is a pain. But I think that pain has been overestimated. I think people will stay put to get 2 shots rather than travel from New York to Florida to try to get a second shot. The Moderna vaccine's a 1-shot deal. We ought to be able to build that out reasonably quickly. So I don't see it taking quite that long, but we'll just have to live through it.
Okay, well, I'm ready for my shot. Give it to me now. I want to get back to normal.
I would like to be the guy with the needle. I took the polio shots as a kid. And we had these squared reusable needles. I'd like to be.
It's I was thinking at 40, 50%, I was thinking I wouldn't bother getting the shot. But truly at 90, 95%, you'd almost be crazy not to.
I think it's an uncivic thing. I think it's a selfish thing not to get the shot. Simply, everyone should get it. I urge President Biden, when he's president or sooner, to take his shot on national TV to help build confidence. What I would really like to see is Mitch McConnell and President-elect Biden together in a photo session, each taking the shot together and urging Americans in unity to line up for their dose. I really would like to see that. This is a civic duty.
Yeah. Well, it's so, assuming you're right, we get, by the second half of next year, things start to look better in terms of COVID spread and then the economy even more so. But, the stock market and what our viewers and listeners want to focus on, it's interesting. You said back in May that retirees, people near retirement, should probably look at more dividend-oriented stocks. And through most of summer, those stocks were out of favor, and we called it early. You called it early, so I'm not picking on you for it for sure. Tech stocks were on a tear, but now it seems like that's turning. It seems like the dividend-oriented value stocks are now coming around. So in the last minute we have right here in this segment, tell our viewers and listeners most important thing they should know in terms of their investment strategies if they're retired or near retirement.
Well, I think now is the opportunity for balance and diversification. My feeling is with the economy coming out, they can overweight a little bit to stocks versus fixed income because fixed income is problematic. And so, we've had a whiplash. So I think now, is a good time for indexing. I don't think it's going to be particularly easy for people to make those hard calls I described in the previous segment.
Yeah, it's gonna be a challenge for sure. So Peter, thanks so much. We appreciate you being back with us as usual. Always great words of wisdom. And you stay with us. We have much more coming up right here on the Income Generation. I'm David Scranton here with Jeff Small, and we'll be right back. The Income Generation is now available on YouTube. Subscribe to The Income Generation so that you never miss a show. You can watch all your favorite episodes now in one place, as well as catch up with your favorite financial guests. Subscribe now to the Income Generation channel on YouTube. For the most part, forecasters are optimistic that the holiday shopping season will be strong this year, even with all the differences. The Big Four accounting firm Deloitte predicts a rise in retail sales of 1 to 1.5% over last year. As for online sales specifically, researchers at Digital Commerce 360 estimate a whopping 43.3% increase over 2019. And all of that bodes well for another strong quarter of GDP growth. But keep in mind, these projections don't account for unpredictable factors, and there are several that could have major impacts. The most obvious, of course, is the ongoing pandemic and the fact that it is, by most accounts, worse than ever and expected to get worse yet in the coming months. Even with a strong holiday retail season, if another widespread economic lockdown becomes necessary, it could still undermine all that spending and send the economy right back in the wrong direction. Neither President Trump nor potential President-elect Joe Biden have announced plans for such a lockdown, but that could always change depending upon the virus and on what impact the vaccine does or doesn't have, provided that one gets approved. Since late October, COVID-19 cases and hospitalizations have been piling up at record rates, and many governors across the country have actually reimposed tighter restrictions on businesses. So even with all the virtual shopping options in the world, these measures can still have harsh impacts in terms of things like jobs, bottom line growth, and tax revenue. One reason for the first widespread lockdown in the spring didn't take an even worse economic toll was the $2.2 trillion CARES Act approved by Congress. Although most lawmakers have agreed since summer that a second round of relief is needed, it's been held up by partisan politics, and of course that continues to be the case even now that the election is over. The absence of more federal aid or an insufficient amount of it could be another wild card factor that plays heavily into just how successful this holiday retail season turns out to be. There are others as well, from concerns about the ability of the physical supply chain to handle the record number of deliveries expected, to worries that many retailers haven't done enough yet to adapt their business models to this new norm. So, how might all of this impact the financial markets, and more importantly, your own finances heading into the new year? We'll talk about that more coming up in just a bit. Now it's time to welcome back our good friend and co-host, Jeff Small. So Jeff, I guess I'm not surprised with what he said economically in terms of, just projecting growth moving forward and everything else. A little surprised what he said at the end about the stock market, though. He had made the call about being into more dividend-oriented stocks back in March. Everybody thought the rotation into that was going to come earlier. It didn't. The tech stocks kept zooming. And it seems like just now over the last couple of weeks, we're starting to see those dividend stocks actually start to take off. So I'm surprised that at this particular point, he changed his advice to say go more indexing. Your thoughts?
Well, I think that his favorite is indexing, but I thought he was kind of a proponent of some of the value stocks with the higher dividends, and he was glad that they were coming around. It was time for them to come around in the rotation of things because tech stocks are just kind of overplayed, they're overvalued, they're overbought, they're over everything, and now we're seeing money that's coming into the market shifting into the part of the market that hasn't been lifted up while we've recaptured a lot of the economic momentum that we lost due to the March shutdown. And so dividend stocks look better than ever, Dave. I mean, high-paying value dividend stocks that give us dividends of 4 to 5% look better than ever. And I think you could probably anticipate some appreciation in those as long as the economic recovery continues. We don't have a relapse into COVID. What do you think?
Yeah, I agree. I think we're there. I mean, we might get a relapse where tech, everything pauses on the more dividend-oriented value stocks, the kinds of things we talk about as being really appropriate for retirees and people near retirement. But if we get that pause and tech stocks jump up for a period of time, it's going to be only that period really while things are spiking. And then as soon as we get more good news about vaccine production, then we go back to the traditional stocks, the staples, if you will, starting to do well, and the cyclicals even starting to do well. I love what he said even about cruise ship companies. You're right. If you really believe in this vaccine, then long term, for somebody who's willing to take the risk, not for retirees per se, but some of the cruise ships, some of the airlines, even Boeing this week now getting the approval for the MAX back on. Some of that stuff could be a good play for a small part, that small speculative part of our viewers' money.
It is, and that's very exciting because we get an opportunity to posture them for success, especially when people like Dr. Scott Gottlieb, the ex-FDA commissioner who's on the board at Pfizer, said recently that this could be the end of the virus. They're projecting it to be the end of the virus, which is incredible news. I mean, that's epic news considering what we've all been through the last several months.
Well, it reminds me, I don't know if any of our viewers, listeners, if you've ever made the trip, having grown up in Connecticut, I would drive to Florida for spring break when I was in college and then for holiday afterward. And it's funny when you're driving down to a place like Fort Lauderdale, where I am now, from Connecticut, you go through all of these states all the way down, and then finally you see welcome to Florida, and you think, yes, we're there, we're in Florida. But really, Florida is such a long state, you're only about 2/3 the way there. You still have a lot of miles in front of you. And I think that's how we are with COVID right now. We still have a lot of miles in front of us because, to get everybody vaccinated, it could be every bit of a year moving forward. So it's great to have the optimism, but we still got to have a little bit of patience over the next many months.
Well, you're exactly right. The vaccine requires refrigeration. They just can't ship it through Amazon. So it requires refrigeration. So that's going to be a huge logistical effort in terms of, getting that out there, keeping it safe and keeping it stored in the meantime while people are doing what? Standing in line to get vaccinated. So it's not going to happen and it's not like going to CVS or Walgreens and getting your flu shot. It's not going to be anything like that.
So we have 1 minute left, as you know, Jeff. It's kind of funny because we talked about the stocks, the dividend stocks being for, really for our viewers, for our listeners who have the risk tolerance, who want to be in the market, but they need income. That's great. But are we ever going to have an economist that says bonds and bond-like instruments actually make sense now? I mean, we're getting a lot of our clients 4%, some even more net of fees in bonds and bond-like instruments. But are we ever going to get economists that knows that? It seems like everybody seems to poo-poo bonds, as Peter did.
Well, I think that when people think of bonds, they think of treasury bonds. And I mean, who wants to buy a 10-year note at 87 basis points under 1% today? Who wants to do that, Dave? That's not exciting. And so I think they kind of lump the whole bond talk, especially when you watch the other networks, they lump that talk into usually T-bonds and things that the government's issuing, and they get away from the other types of bonds that we work with on a daily basis for our customers. Yeah,
that's right. Well, bottom line is, it gives people comfort to know, hey, if I've got $500,000, that's $20,000 of income I could generate without touching my principal. If I've got $1 million, that's $40,000 a year I could generate without touching principal. And that peace of mind is what our viewers and listeners at or nearing retirement really need the most. So we take another break. You stay with us. We have more coming up right here on the Income Generation. We'll be right back. I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Don't waste any more time. Visit myfreeretirementreview.com to find out if you have the right retirement strategy in place. David J. Scranton's groundbreaking new book, The Retirement Income Story, will revolutionize the way baby boomers and their advisors plan and save for retirement. The Retirement Income Story, the story behind the launch of the Retirement Income Store, is about to shatter many of the myths Wall Street bankers have promoted and protected for decades. David outlines what he believes to be a much better method for planning and saving for retirement, one that doesn't involve taking on more stock market risk. In fact, most will be able to reduce and or possibly even eliminate stock market risk while creating renewable streams of income they can count on well into their retirement years. The simple truth is that if you were born in 1968 or sooner, you can't afford to ride out another catastrophic stock market drop like the ones in 2000 and 2007. Read The Retirement Income Story and revolutionize the way you plan and save for retirement.
Only a week or so before the post-election stock market run-up, Wall Street took another major nosedive. And there were several reasons for it, including uncertainty around the election, these reports of spiking coronavirus cases, and the crash of a major tech company in Europe. Now that the markets have rebounded again and analysts are forecasting a robust holiday shopping season, does that mean that everything is hunky-dory? Well, of course not. Even if you disregard all the wild card issues that I discussed, like the potential for another lockdown, more layoffs, the uncertainty around the vaccine and when we'll have enough to supply all of us, and more federal relief, the reality is still this. According to the Conference Board Economic Index, based on data from the Bureau of Economic Analysis, GDP growth for 2020 is expected to be around minus 3.6%. And that's a base case scenario, I should say. It could be a bit better or a bit worse, but most analysts agree that even with a strong holiday season, we'll end up with negative growth for the year thanks to that massive decline we saw in the second quarter. So here's the point. Since the stock market is forward-looking, it would seem that right now it's looking forward in an unusually long way. In fact, about a year. Between now and then, given all the uncertainties we've talked about and many others, I believe the potential for another market correction exists. And that's important to keep in mind if you're in or near retirement and if you haven't yet made that oh so important shift in your financial strategy from one of portfolio growth to one of portfolio retirement income. Now it's time to bring back our good friend and co-host Jeff Small, as well as our next guest, another good friend of the income generation, as well as a good friend of yours truly, Eddie Ghabour, co-owner of Key Advisors Group, located in Lewis, Delaware. Eddie is Amazon best-selling author of the book, Common Sense Bull. So, how are things going with COVID around your neck of the woods?
Look, we're dealing with some of the same things everyone around the country's doing. Overall, my family's healthy. Our clients have been healthy, so we're thankful for that. But our governor has, just as of yesterday, put on some more restrictions because we're seeing a spike here in the Northeast. Everyone's dealing with it the best that they can. Some people are getting hurt a lot harder than others. Obviously, the restaurant space, and my heart goes out to them. Mm-hmm. It's unfortunate that our state is having to do rollbacks again.
Yeah. All I can say is with those kinds of politics, good thing your state doesn't have a lot of influence over the House of Representatives. But,
yes.
Jeff, I have nothing to say after that. I need to toss it to you.
Okay, no worries, Dave. I got you. So, Eddie, listen, the economy has recovered really quickly here despite the overhangs of the virus. And with the fiscal accommodations made by the Fed and Congress did earlier this year, the market just came back with a passion, and so did unemployment as well, even though we're still dealing with this virus. Now the vaccine's been unleashed, but it's looking to me like full bull. The full bull market is going to be enraged here the next 12 months. What do you think?
I agree with you. I mean, I think the backdrop for a bull, frankly, in my opinion, couldn't be any better than what you're getting ready to see in the next 12 months. The vaccine news, the biggest game changer in regards to that is the 95% effective rate that these companies have come out with. So you've got cash on the sidelines, you've got an accommodative Fed, you've got a split government, and you got an economy and consumers that are going to be ready to really open this thing up. And so I'm extremely bullish the next 12 months. I think the recovery stocks are where the place to be to make some serious money. And I think you're going to see some really nice double-digit returns in the market next year.
Well, I want to key on for a minute what you said, which was critical. Those factors are spot on. But a split government, we're not quite there yet because the Georgia Senate race there's 2 races there that have to be concluded. And if we have the blue wave take over those 2 races and capital gains rates get increased, because we know that's going to be on the agenda, what's that going to do to the market going forward?
So look, if that goes in the wrong direction and the Republicans lose both of those, I think the short-term spike you saw because of a split government will be erased. As you know, we make decisions based on statistical probabilities. We feel pretty strongly that 1 of 2 will go to the Republicans and we will have that split government. But if that doesn't happen, we will switch gears because the bullish case won't be as bullish because the corporate tax structure, the capital gains, even the stepped up cost basis is all on the table. And that's a game changer from an investment perspective.
Yeah, there's no doubt about that, Eddie. And the other game changer, of course, has been the news of the virus as Pfizer tries to outdo Moderna. And then there's a third one coming on deck here shortly. They're all going to be incredibly effective, apparently. But it's going to take several months to roll out these vaccines. And I don't see it happening until the back half or maybe at the end of next year, because a lot of these vaccines require refrigeration while they're being transported and while they're being stored, while you and I stand in line with our children to get these vaccines. And so I don't know if it's going to be full bull between now and then, but for today it is, at least. I agree with you on that.
That's right. It's game on for today, the way it looks. We can take a quick commercial break. Stay with us. We have much more coming up in just a moment from our good friend Eddie Ghabour. Stay with us. We'll be right back. Welcome back to The Income Generation. I'm here with Jeff Small and our good friend Eddie Ghabour, co-owner of Key Advisors Group in Delaware. So Eddie, you mentioned rebound stocks, I believe is the term you used. So when you say rebound stocks, I'd like you to clarify, because some people think, oh, that's the tech, the Zooms of the world, the Amazons of the world continuing to take off. Others say rebound stocks means the more value-oriented dividend-type plays that we've really been waiting to get back into now for a while.
Yeah, we have started to rotate out of technology and going a little bit overweight value. I think the value stocks are going to be the place to be the next 12 to 24 months. And frankly, I'll go ahead and put myself out there on a limb. I think the NASDAQ will be the worst performing index next year. So rotating out of those stay-at-home companies and going more into the value stocks that frankly haven't participated in these gains. There's lots of companies that are still down double digits year to date that when we open up over the next 12 months, in our opinion, they'll be the leaders.
That makes sense. Hold on, Eddie. Excuse me for a second here. Sarah Rich, will you do me a favor? Tomorrow morning when the market's open, could you tell our traders to sell all my tech stocks and to buy value stocks because of Eddie's recommendation? So I want to make sure it's Sunday, so I want to make sure you get that squared away first thing in the morning. So Eddie, in all seriousness, I agree with what you just said. Okay, your clients. What are your clients' biggest concerns now that you hear them talking about, let's say over the last couple of weeks or so?
The biggest concern that we're hearing from our clients, really, they're very worried about the deficits that this country continues to take on. And they're worried about inflation. They've always been concerned with risk management, but these are some of the things with this stimulus and all this money that's being pumped into the system. We know short term it's bullish for equities, at least that's our opinion. But long term, there is going to be a price to pay for all this money. As you know, there's no such thing as a free lunch. So this printing press that keeps going on has our clients very concerned about the future direction of this country and inflation.
Okay, it's got our clients concerned. I get that, because the economic textbooks say when you print a lot of money, you create inflation. But essentially, the Fed had been doing that for about 10 years, and and they couldn't manufacture anything more than 2% inflation. Because now we have this world of asset inflation where stocks are going up, real estate's going up, not so much income inflation. So do you agree with your clients? Is that being a legitimate concern? Or do you think just a short-term inflation spike because we have limited supply due to supply chain limitations of COVID, but then we go right back to asset inflation?
So I agree with you, Dave. You're going to see asset inflation, but I am concerned about debt. Look, I think when you look, any country, any company, at some point in time, there is a price to pay for having too much debt. And I think the minute that somebody or a company or a country gets too arrogant and thinks that they can just take on as much debt as possible, I think that's just a wrong way to think of things. So do I think it's an immediate risk? No, I don't. But long term, I am worried about it.
Well, Eddie, you got a really good point there. But as long as we can grow the economy faster than the debt, because we're not doing that right now today, but as long as we can grow the economy faster than the debt, then that's okay, especially in a low rate environment. It's when you over subsidize an economy with consistent stimulus by the way of Fed or by way of congressional, that we create an environment where the markets and earnings can't grow anymore. And Japan has been stuck in that rut since 1988, the first country to do quantitative easing, the first country to go to 0% interest rates. And so we're not too far behind in that monetary pattern, but hopefully we'll learn a lesson to make sure we expand the economy more so than we do the debt. But at 0%, does it really matter? It doesn't. They got a blank check, Eddie.
That's why I say short term, it doesn't matter because rates are basically zero, as you said. It's not going to stay that way forever. I know they would like to tell you conceptually that they can do it that way, but it's not. I believe in the capital markets, and I don't think the rates are going to stay at this level. And this is why, indirectly, this will affect investments long term too. Tax rates are probably going to go up because if the GDP can't cover the debt payments, they're going to come and get that revenue from somewhere else. And that's going to be in the form of higher taxes, and that can hurt investments as well too.
Sure. Eddie, 40 seconds left in the segment here. What lessons have you learned as a professional, as an expert in these areas over the last 9 months or so that you'd like to share with our viewers and our listeners?
Look, one of the things that this year has done, which I think it's the best learning experience anyone can have in this business, because this is real life stuff, is don't ever take your eye off the ball when it comes to risk management. Some people got too comfortable in February and they got whipsawed and lost half of their portfolio. So risk management, in our opinion, should be top of mind at all times, no matter how bullish you are.
Absolutely. Great words of wisdom. And, you know, in your risk management is specific for the individual. So we appreciate you, of course, as usual. Eddie, thanks for being here.
Thank you for having me.
And you stay with us, too. We're not done yet. We have more to come right here on The Income Generation. We'll be right back. I'd like to thank our guests, Peter Morici and Eddie Ghabour, as well as my good friend and co-host, Jeff Small, for joining me today on The Income Generation. Most importantly, I want to thank you, our new and returning viewers. So you don't need me to tell you that 2020 has been a really challenging year. The fact that you won't be able to enjoy some of your favorite holiday traditions, including carefree shopping experiences in your favorite stores, is just one more challenge on top of the pile. Even if you do venture out, you know it won't be the same because nothing has really been the same for any of us since March. However, we've adapted and we're continuing to adapt. And in doing so, we've managed to pull our economy out of a huge hole and keep it moving in the right direction since late spring. And fortunately, most forecasters are optimistic we'll continue doing that throughout this holiday season. To what extent, of course, remains to be unseen. There are, as we discussed, several unpredictable factors that could affect the answer. This includes things like the potential for another major lockdown and more layoffs, and the ongoing uncertainty around the next round of federal relief. Yes, there's been some welcome good news lately. The vaccine, the election, third quarter growth, and Wall Street has celebrated. But always remember two things about the stock market. It's driven by emotion, and that is hope and fear, and that it's forward-looking. These days, it seems to be looking forward a full year because realistically speaking, it's probably going to take at least that long for true economic growth to catch up with where the market is at now. Between now and then, I believe the potential for another major market downturn remains in place. So if you're in retirement or near retirement, it's important to keep in mind as you review your financial strategy for the coming year, with the help of the right advisor, of course. An advisor who specializes in retirement income can help make sure you have a plan that's just right for you. One that helps to ensure your investments are generating reliable income regardless of market conditions. If you have the right risk tolerance, that means an advisor that positions you to take advantage of new opportunities for more income and potential growth when the time is right. We hope you have a happy Thanksgiving. We're off next week for the holiday, so we'll be re-airing our interview from earlier this year with best-selling author Susie Orman. She discusses her new book, The Ultimate Retirement, and she will share her own retirement strategies with you. So if you missed the interview in March, you don't want to miss next week's episode. As always, stay safe and thanks for watching. If you're close to or in retirement and you're concerned about your money, it's essential you stay informed and up to date. And right here is where you can do it on the Income Generation. I'm David Scranton, and we'll see you next week.